I am Ashok Kumar, Aggarwal Academic Counselor, IGNOU. Now we are going to study MNPC 014 Financial Management, Block 1 Financial Management and Overview, Unit 1 Financial Management and Introduction. Every business organization, proprietorship, partnership, private limited company, public limited company, one person company, a limited liability partnership, irrespective of its size, requires a sound and effective financial structure to operate smoothly. Various activities such as production, then marketing, then human resource management and finance. Finance is most important, must be carried out efficiently to achieve the organization's goals. Whatever organization wants to achieve, whatever sales target they want to achieve, for this, the activities such as production, marketing, human resource management and finance all are very important. Among these, finance holds a unique and vital place. Finance is often referred to as the lifeblood of a business, because all other business functions depend on the availability and management of funds. From where the funds will come and how the funds are going to be utilized. Finance ensures the acquisition and utilization of money resources needed to run daily operations, invest in long-term projects and meet emergencies. Whenever we start a business, first of all, we should have land, then we should construct the shade, factory premises. Then, we have to bring the machineries, then we have to, engage the labor and raw material. We have to buy the raw material. Then the production will be, started. Without adequate, all these, activities need money. Without adequate finance, even profit-generating business may not survive in the long run. It is also crucial before the business starts operations, as finance helps assess the feasibility of ventures and ensure the firm's economic, viability. The finance function plays a dual role. On one hand, it facilitates the availability of funds. On the other hand, it ensures that optimal utilization to generate returns for the business and its stakeholders. Thus, understanding the meaning, nature, scope, and significance of financial management is essential for long-term, business sustainability and growth. Now, whenever any firm, approaches bank for finance, bank, will study the past, balance sheets of the business, and then whatever is the requirement of the business, bank will assess whether that requirement is genuine. Now bank will ask about the projected balance sheets for the next 3 years. What are going to be the sales of the business next year, then for 2 years more. Accordingly, bank sanctions the limits. Bank can sanction term loans for fixed assets. Bank can sanction cash credit limits for, working capital funds. If the business needs funds, for manufacturing, business will need the money for buying raw material. Business will need the money for paying to labor. And then every, month, electricity bill and other, water charges, all these charges, are needed. So for this, what bank does? Bank gives a cash credit limit, to the firm. Cash credit means, whenever company wants money, they can withdraw. They are in a position to withdraw from the account. Whenever company receives money, when the sales, sales proceeds, company receives, company can deposit that in the account. so that you see the interest will be charged in the account accordingly. Whatever is the balance in the account, interest will be charged. Whatever is the debit balance, interest will be charged on that debit balance. So this is a running type of account, and every year this account is, you see, renewed. Bank sees whether the company is short, needs more funds, bank will increase the limit. If the company is not utilizing the entire limit, bank will, you see, reduce the working capital limit. So now we come on the next slide. You see nature of finance function. The finance function is primarily concerned with the process of planning, acquiring, managing, and controlling a firm's financial resources to achieve its business objectives. It involves decisions on how to raise funds, whether you see shares are to be issued, how to deploy them. Then once the firm gets the funds, then how to deploy them and how to manage them in such a way that they, you see, contribute to wealth creation. You see, the essence of the finance function lies in making rational and prudent, you see, decisions regarding the procurement and utilization of funds. Traditionally, the finance function was seen as a clerical job limited to routine activities such as keeping accounts and managing cash flows. However, modern finance has evolved into a strategic managerial function that impacts almost, you see, all areas, you see, of a business. The finance function can be categorized into two broad types: routine and, you see, managerial. The routine functions are operational and clerical in nature. These include the supervision of cash receipts and disbursements, safeguarding financial documents, managing insurance and securities, and ensuring proper record keeping and reporting. While important, these tasks do not require high level of, you see, managerial expertise. Managerial functions, on the other hand, are strategic and involve critical financial decisions. These include raising capital, determining capital structure, allocating funds among various assets, managing risk and taxation, and dealing with cost control. These functions demand analytical skills and are closely tied to achieving the long-term financial health of the firm. Approaches to financial management. There are two primary approaches to understanding financial management: the traditional approach and the modern approach. These approaches differ in terms of scope, orientation, and the role of financial managers. The traditional approach to financial management, which prevailed until the 1950s, viewed finance as narrow discipline focused primarily on the process of raising funds for business needs. It concentrated on procurement of funds through external sources like banks, investors, and financial institutions, and gave little attention to the internal use of funds. Financial management under this approach was often synonymous with corporate finance and was largely concerned with events like mergers, acquisitions, restructuring, and liquidation. This approach had several limitations. Firstly, it considered finance from the viewpoint of external stakeholders rather than internal decision makers. Secondly, it focused on rare and episodic events instead of, you see, everyday financial operations. Thirdly, it ignored important areas such as, you see, working capital management, cost analysis, and internal controls. Consequently, the traditional approach failed to address the key financial issues faced by business on a day-to-day basis. The modern approach, which emerged post 1950s, expanded the scope of financial management significantly. It views financial management as an integral part of overall business management. This approach emphasizes the efficient and effective use of financial resources and includes all aspects of financial planning, control, and decision making. It recognizes that finance decisions have wide-ranging implications on the profitability, risk, and the value of the firm. The modern approach categorizes financial management into three primary decision areas: investment decisions, capital budgeting; financing decisions, capital structure; and dividend decisions, profit distribution. The modern financial manager is responsible not only for raising funds but also for determining the most beneficial ways to utilize them. You see, funds can be raised by issue of shares, debentures, then borrowings from banks, financial institutions, and utilization of the money for production is buying raw material, engaging labor, then other charges regarding manufacturing, then we will have work in progress, then finished goods, and when we will sell the finished goods, we will mostly it is sold on credit, and when the debts are realized, firm is getting the money. The goal is to maximize the firm's value and wealth for shareholders. Shareholders, what they expect: good dividend. Once they have invested the money in the shares of that particular company, they will expect the price of the share, their price of the share should increase, and secondly, they should get good dividend. So this approach is analytical, comprehensive, and aligns finance with overall business strategy. Now, major financial decisions. A firm's financial decisions are crucial because they directly influence the market value and profitability of the organization. These decisions revolve around how funds are raised, how they are invested, and how profits are allocated. There are three major financial decisions in any firm. The investment decision pertains to the selection of assets in which the firm should invest its funds. These decisions can be divided into two types: long-term investment decisions, capital budgeting, and short-term investment decisions, working capital, or liquidity management. Next is capital budgeting. Involves choosing among various long-term investment opportunities based on expected future benefits. Since these returns are realized over a period of time, techniques such as present value and internal rate of return are used for evaluation. Then investment decision. These decisions are complex due to the risk and uncertainty associated with future cash flows. Liquidity decisions deals with the management of current assets and liability. A firm must maintain adequate liquidity to meet short-term obligations, while also ensuring that excess funds are not idle. They should be invested. Then and only then the company will earn profits. Striking the right balance between liquidity and profitability is essential for operational efficiency. Now, if we take the example of a bank, they accept deposits from the public for the purpose of lending. If they don't lend the money, the deposits which they have received from the public, they will be paying interest on those deposits. If those funds are idle, they are lying idle in the bank, then how bank is going to make profit, and how bank is going to give interest on those deposits to the customers? So they invest those deposits. They do investments, they give loans, you see. Then in loans, they are charging a bit more rate of interest. In deposits, you see, they are giving less rate of interest compared to interest charge on loans. That is how the bank makes, you see, profit. So investment decision, these decisions are complex due to the risk and uncertainty associated with future cash flows. Liquidity decisions, you see, deal with the management of current assets, you see, and liabilities. Uh, if we reduce from current assets, current liabilities, we get working capital. A firm must maintain adequate liquidity to meet short-term, you see, obligations, while also ensuring that excess funds are not, you see, idle. Striking the right balance between liquidity and profitability is essential for operational efficiency. Financing decision, once investment decisions are, you see, made, the firm must decide how to, you see, finance these investments. The financing decision rate relates to determining the optimal mix of equity and debt in capital structure. A sound capital structure minimizes the cost of capital while maximizing the value of the firm. The financial manager must assess the cost, control implications, and risk associated with different sources of finance. The objective is to achieve a balance where shareholder wealth is, you see, maximized without exposing the firm to excessive financial risk. Third one is, you see, dividend decision. The dividend decision involves determining the portion of profits to be distributed to, you see, shareholders versus the portion to be retained for reinvestment, you see. So some money is retained in the business and some money is distributed to the shareholders as a dividend. A good dividend policy must maintain a balance between rewarding shareholders and retaining earnings for future growth. You see, money is reinvested in the business. The impact of dividend decisions on share price, investor satisfaction, and the firm's reputation must be considered. The goal is to choose a policy that enhances shareholder value over time. Now, what are the objectives of the firm? The fundamental objective of a business enterprise is to maximize the economic benefit for its owners, you see, that is the shareholders, to give, you see, more and more dividend, as well as the share price, you see, in the stock market should also increase. You see, that is what shareholders, you see, expect. In the corporate structure, shareholders are the owners. They are the owners of the business, and management is entrusted with the responsibility of running the business. Therefore, management decisions should ideally align with the objective of shareholder wealth maximization. You see, two major objectives have been proposed in financial theory: profit maximization and, you see, wealth maximization. Profit maximization implies that the firm should undertake activities that increase its profits and avoid those that reduce them. It is an intuitive and straightforward goal. However, this approach has several limitations. Firstly, profit is a vague term and can be interpreted in many ways. That is gross profit, then net profit, then operating, you see, profit. Secondly, it does not consider the, you see, timing of returns. Early returns are, you see, more valuable than later ones due to the time value of, you see, money. Now, if you are going to get the proceeds after 1 year, and what is the value of those? What will be the value of those proceeds today? You see, Thirdly, now profit maximization. Thirdly, it ignores the risk factor associated with various, you see, investment opportunities. It assumes certainty in future earnings, which is unrealistic in a dynamic business environment. Moreover, you see, profit maximization may lead to unethical practices or excessive risk, you see, taking in pursuit of higher returns. For example, now you see, if you invest money in a bank, you see your money will be very safe, and bank will, the principal will remain always intact, and bank will give you, you say, 7%, 8%, 9% interest. Whereas if you invest in stock market, you see, today you have invested 1 lakh, tomorrow its value may be 90,000. Its value can be 1,20,000 also. So the more safe investment is investing money in the bank. So moreover, profit maximization may lead to unethical practices or excessive risk taking in pursuit of higher returns. It does not ensure long-term sustainability or stakeholder satisfaction. Therefore, profit maximization is now considered an inadequate and outdated financial objective. Wealth maximization, also known as, you see, value maximization or shareholder value maximization, is a more comprehensive and acceptable financial goal. It aims to increase the net present value of a firm's future cash flows, thereby maximizing the market value of the shareholders' equity. This approach considers the quality, timing, and risk of returns, making it superior to profit maximization. Wealth maximization emphasizes the use of financial tools such as discounting, cost of capital, and risk return analysis to make informed decisions. It supports sustainable growth and long-term profitability. Moreover, it aligns with broader corporate responsibilities such as employee welfare, environmental protection, and social contributions. Thereby, wealth maximization is a central guiding principle for modern financial management. Risk return trade-off. All financial decisions involve a trade-off, you see, between risk and return. Higher returns are generally associated with higher levels of risk. This relationship is fundamental to investment and financing decisions. Investors demand a return that compensates them for both the time value of money, that is risk-free rate, and the risk associated with a particular investment, that is risk premium. Financial managers must evaluate various opportunities by analyzing their expected returns and associated risks. The goal is to achieve an optimal balance that maximizes shareholder value while maintaining an acceptable level of risk. This principle is particularly important in portfolio management, capital budgeting, and capital structure decisions. Portfolio, what do we mean by portfolio? Suppose you see you are having a basket of investments. You have invested money in LIC, you have invested money in bank, you have invested money in shares, you have invested money in debentures, you have invested money in mutual funds. So all these are your, all this is your portfolio. You see, bucket of investments. That is what is, you see, portfolio. So in the portfolio, some investment should be, you see, where risk is more. In some investment should be such that where risk is very less. For example, investing in money in bank fixed deposit. You see, banks never fail. At the most, if any bank you see fails, then Reserve Bank, the central bank of our country, it merges that bank, you see, with some other big bank. But your money, depositors' money will be intact. Secondly, you see, all the depositors, you see, up to 5 lakhs, that insurance, their deposits are insured by Reserve Banks. There is a, you see, Reserve Bank's rule that the deposits, you see, of an individual person in a bank up to 5 lakhs are insured. If the bank fails, then government will give, this insurance company will give that money. So financial managers must evaluate various opportunities by analyzing their expected returns and associated risks. The goal is to achieve an optimal, you see, balance that maximizes shareholder value while maintaining an acceptable level of risk. This principle is particularly important in portfolio management, capital budgeting, and capital structure decisions. Financial goals and broader business objectives. While maximizing shareholder wealth is the central financial objective of the firm, firms also pursue broader goals related to their vision, mission, and social responsibilities. These include providing, you see, quality products and services, achieving technological excellence, maintaining employee welfare, and contributing to society. A firm must balance the economic interest of owners with the expectations of, you see, other stakeholders such as customers, employees, creditors, regulators, and the community. Financial decision must be ethically sound and socially responsible. Thus, wealth maximization should be viewed not in isolation, but as part of a broader commitment to corporate sustainability and stakeholder welfare. Now, conflict between management and owners. You see, in a joint stock company, there is a separation between ownership and management. This creates the potential for a conflict of interest known as the principal agent problem. Managers, agents may pursue control in a joint stock company. There is a separation between ownership and management. This creates the potential for a conflict of interest known as the principal agent problem. Managers, agents may pursue personal goals such as, you see, job security, power, or prestige, rather than, you see, shareholder wealth maximization. This conflict can lead to inefficiencies and suboptimal, you see, financial decisions. However, such managerial behavior is considered by various internal and external controls. Shareholders can influence management through voting rights, board supervision, audits. Every company is to be, you see, the balance sheet of the year end. It is to be audited by the, you see, chartered accountants, and performance evaluation. The competitive market and regulatory bodies also ensure that managers are accountable for their decisions. Alignment of managerial incentives with shareholder interests, such as through performance-based bonuses or stock options, you see, can reduce such conflicts. Organization of the finance function. The structure of the finance function varies depending on the size and complexity of the firm. In large organizations, the finance department is a major functional area, headed by a finance director or chief financial officer who reports to the board of directors. Under the chief financial officer, the department may be divided into specialized roles such as controller and treasurer. The controller oversees accounting, budgeting, internal audits, and financial reporting. The treasurer handles capital raising, investor relations, cash management, and risk management. Each role plays a strategic part in ensuring the firm's financial stability and compliance. The organization of the finance function ensures that financial planning, control, and reporting are conducted in a systematic and integrated manner. It also ensures that legal, regulatory, and ethical standards are maintained. Now, what is the role of the finance manager? The finance manager plays a crucial role in both strategic and operational decision making. Their responsibilities include estimating capital requirements for projects, maintaining liquidity. Every time whenever you see any requirement of money is there, liquidity should be there, and solvency, managing relations with financial institutions, and evaluating financial risks. They are also responsible for credit policy decisions, internal controls, compliance with financial laws, and setting the firm's dividend policy. A finance manager must balance profitability with risk, short-term needs with long-term growth, and shareholder interests with corporate social responsibility. In doing so, they contribute directly to the overall financial health and strategic direction of the firm. Finance and related disciplines, financial management is management is closely linked with several other disciplines, particularly accounting and economics. While accounting provides the data and records necessary for financial decision making, finance interprets and uses that data to make strategic choices. Accounting is based on accrual principles, while finance emphasizes cash flows and timing. Economics provides the theoretical foundation for financial decision making. Concepts such as managerial cost, opportunity cost, and market equilibrium are essential for evaluating investment and financing alternatives. Financial management also draws from areas like statistics, operations, marketing, and strategy to ensure well-rounded business decisions. Financial management is essentially for planning, acquiring, and utilizing funds to ensure a business profitability and sustainability. The unit explains the evolution from a traditional focus on fundraising to a modern approach that includes investment, financing, and dividend decisions. It emphasizes wealth maximization as the key objective, considering risk and time value of money. The finance function supports broader business goals and must balance the interests of shareholders and other stakeholders. The finance manager, plays a strategic role, and financial management is closely linked with accounting and economics. So, in this unit, we have studied financial management is essential for planning, acquiring, and utilizing funds to ensure a business profitability and sustainability. The unit number 1 explains the evaluation from a traditional focus on fundraising to a modern approach that includes investment, financing, and dividend decisions. It emphasizes wealth maximization as the key objective, considering risk and time value of money. The finance function supports broader business goals and must balance the interest of shareholders and other stakeholders. The finance manager plays a strategic role, and financial management is closely linked with accounting and economics. Now we come on unit 2, time value of money. The fundamental principle behind the concept of time value of money, in short we write TVM, is that a rupee received today is more valuable than a rupee received in the future. You see, this is due to several reasons, such as the ability to invest and earn interest on money today, uncertainty about the future, inflation, and loss of purchasing power over time. You see, now inflation, you see, rising of prices, you see, there is uncertainty about the future, you see what will happen in future, and loss of purchasing power, you see, over time. For instance, if someone offers you rupees 75,000 today or 1 lakh after 5 years, the instinctive decision would often be to accept rupees 75,000 now. That's because money in hand today can be invested and grown, whereas the future is uncertain and inflation will likely to reduce the real value of 1 lakh after 5 years, because things will become costly. Whatever you can purchase today, in 75,000, after 5 years, the same goods you will not be in a position to purchase for 1 lakh rupees. The time value of money is not just a theoretical concept, but a practical tool used extensively in financial decision making. Whether it is on investment appraisal, retirement planning, or loan analysis, the time dimension of money plays a central role. Understanding and applying this concept correctly allows individuals and businesses to make informed choices among various financial alternatives that involve cash flows occurring at different points in time. The time value of money is not just a theoretical concept, but a practical tool used extensively in financial decision making. Whether it is an investment appraisal, retirement planning, or loan analysis, the time decision of money plays a central role. Understanding and applying this concept correctly allows individuals and businesses to make informed choices among various financial alternatives that involve cash flows acquiring at different points in time. Future value, we write it as FV. The future value of money refers to the value of a current amount at a future date, based on an assumed rate of return or interest. It helps in estimating how much today's investment will grow over a period. For financial planners and investors, calculating future value is crucial in understanding the outcome of current investments and planning accordingly for future needs. The future value can be impacted by factors like the rate of return and the period of investment, but it is also influenced negatively by inflation and other external economic variables. In its simplest form, future value is calculated using either simple or compound interest. While simple interest calculation calculates interest on the original principal only, the compound interest adds interest to the accumulated amount, making it a more accurate and realistic measure in financial scenarios. For example, now 3 years interest, if we find out on 1 lakh rupees, rate of interest is 10%. If it is simple, our formula will be 1 lakh multiplied by 10 multiplied by 3 divided by, you see, 100. But if we find out compound interest, what we have to do, rate of interest suppose is 10% per annum. So 1 lakh we'll find out first the interest for the first year. Then we'll add that interest in the principal. That becomes the principal for the second year. We'll find out interest on that. Then third year principal, you see, we'll take 1 lakh plus we'll add interest of first 2 years. So that becomes the principal for the third year. Then we work out the interest. This is compound interest formula. So the future value can be impacted by factors like the rate of return and the period of investment, but it is also influenced negatively by inflation and other, you see, external control economic variables. In its simplest form, future value is calculated using either simple or compound interest. While simple interest calculates interest on the original principal only, compound interest add interest to the accumulated amount, making it a more accurate and realistic measure in financial scenarios. Now, calculation of future value calculations are generally divided into two categories: the future value of a lump sum and the future value of an annuity. The future value of a lump sum refers to the value of a single investment made today after a certain number of years at a given rate of interest. So, future value calculations are generally divided into two categories: the future value of a lump sum and the future value of an annuity. The future value of a lump sum refers to the value of a single investment made today after a certain number of years of a given, you see, interest rate. Now they have given the formula here: future value FV, simple lump sum, you see, simple interest. FV is future value, P is principal, R is rate of interest, T is time. So FV is equal to future value principal into, you see, 1 plus rate into time. This is the future value. So rate of interest formula is, you see, we have already seen principal multiplied by rate multiplied by time. If the time is in days, then divide by 36500. So here, same formula, you see, they are finding out the future value by using the same formula. They are, you see, adding the principal and, you see, interest. That is the future value. In contrast, the future value of an annuity refers to the future worth of a series of equal payments made at regular intervals. Annuity means same amount you pay every month. It is used in scenarios like insurance premiums or retirement savings, where fixed amounts are usually deposited periodically. Now, future value of an annuity is equal to, this is the formula, FVA, we write future value of an annuity is equal to A multiplied by 1 plus R raised to power T minus 1 divided by R. So FVA is equal to future value of annuity. A is constant periodic payment. R is rate of interest per period. T number of periods. You see, this is the formula. Through these formulas, one can determine how much a present sum or series of sums will grow to in the future. Higher interest rates and longer investment durations yield higher future values. You see, suppose investment is made for 5 years. Naturally, if you invest for 3 years and if you invest for 5 years, the investment which is made for 5 years will fetch you more, you see, interest. So, through these formulas, one can determine how much a present sum or series of sums will grow to in the future. Higher interest rates and longer investment durations yield higher future values, but also involve, you see, greater uncertainty and risk. Now, present value versus future value. Present value, we write it PV, is the reverse of future value. It represents the current worth of money and is expected to be received in the future. That is to expected to be received in future. So present value is the reverse of future value. Present value represents the current value of money that is expected to be received in the future. Present value is calculated by discounting future amounts using a discount rate, which is essentially the expected rate of return or opportunity cost. The principle behind present value is simple. A rupee to be received in the future is not as valuable as a rupee in hand today. The further in the future the cash flow is expected, the less it is worth today. Present value is widely used in real world applications such as valuing investment projects, determining pension values, and deciding between lump sum and annuity payments. It serves as the foundation of most financial appraisal methods, including net present value and discounted cash flow analysis. Now, present value versus future value. Present value PV is equal to FV divided by 1 plus R raised to power T. PV is equal to present value, FV is equal to future value, R is the discount rate, and T is number of years. So, the formula for present value PV is equal to FV divided by 1 plus R raised to power T. Now, PV is present value, FV is future value, and R is discount rate, and T is number of years. So the formula is FV divided by 1 plus R raised to power T. Time value and money and its significance. The concept of time value of money is extremely significant in financial decision making because it affects how we evaluate investment opportunities, compare alternatives, and manage resource efficiently. Time value money assists in determining whether an investment is worth pursuing by comparing the present value of expected returns against the current cost. For business growth and expansion, companies need to evaluate sources of finance such as equity or debt, and the time value of money helps in assessing the cost and benefit of each source. Time value of money and its significance. Since future outcomes are uncertain, time value of money offers a systematic approach to account for time, interest, risk, and inflation, thereby enabling more rational financial planning. An example that illustrates the importance of time value of money is comparing two projects. Project A promises a return in the first 5 years, while project B offers the same amount in the 5th year. Although the nominal values are the same, the present value of project A is higher, making it a better choice. The simple logic underlines how crucial the time value of money concept is in financial strategy and evaluation. Application in financial decisions. The time value of money plays a critical role in financial decisions, especially in investment and financing. Financing decision. The investment decisions involve evaluating whether the present value of expected cash inflows from a projected exceed the initial investment cost. This requires discounting future cash flows to the present using the firm's cost of capital. If the net present value NPV is positive, the investment is considered viable. For instance, if a project costing rupees 1 lakh is expected to generate future cash flows that are worth only rupees 92,000 in present value terms, it should be rejected as the return is insufficient to cover the cost of the investment. Because today the value is 1 lakh, and after some time, the value expected to be 92,000. That 92,000, if a project costing 1 lakh is expected to generate future cash flows that are worth only rupees 92,000 in present value terms, it should be rejected as the return is insufficient to cover the cost. Now, financing decisions. In financing, TVM is applied to evaluate the cost of raising capital through methods such as issuing debentures or taking loans. When a company raises funds today, it commits to future cash outflows in the form of interest and repayment. These outflows must be discounted to the present to assess whether the financing cost is justified. The analysis helps in deciding whether to issue new debt and at what terms. So we have studied, you see, time value of money is a cornerstone of financial management. It reflects the principle that money available now is worth more than the same amount in future due to its potential earning capacity. The concept is applied in all major financial decisions such as investment, evaluation, project selection, financing alternatives, and retirement planning. It helps in comparing cash flows occurring at different times by converting them into present or future values. Mastering TVM enables more accurate and informed decision making, thereby enhancing, you see, financial efficiency and profitability. So, time value of money and its significance. The concept of time value of money is extremely significant in financial decision making because it affects how much we evaluate investment opportunities, compare alternatives, and manage resources efficiently. Time value of money assists in determining whether an investment is worth pursuing by comparing the present value of expected returns against the current cost. For business growth and expansion, companies need to evaluate sources of VC finance such as equity or debt, and the time value of money helps in assessing the cost and benefit of each source. So, the concept of time value of money is extremely significant in financial decision making because it affects how we evaluate investment opportunities, compare alternatives, and manage resources efficiently. Time value of money assists in determining whether an investment is worth pursuing by comparing the present value of expected returns against the current cost. For business growth and expansion, companies need to evaluate sources of finance such as equity or debt, and the time value of money helps in assessing the cost and benefit of each source. Since future outcomes are uncertain, time value of money offers a systematic approach to account for time, interest, risk, and inflation, thereby enabling more rational financial planning. An example that illustrates the importance of time value of money is comparing two projects. Project A promises a return in the first year, while Project B offers the same amount in the fifth year. Although the nominal values are the same, the present value of Project A is higher, making it a better choice. This simple logic, you see, underlines how crucial the time value of money concept is in financial strategy and evaluation. So, since future outcomes are uncertain, time value of money offers a systematic approach to account for time, interest, risk, and inflation, thereby enabling more rational financial planning. An example that illustrates the importance of time value of money is comparing two projects. Project A promises a return in the first year, while Project B offers the same amount in the fifth year. Although the nominal values are the same, the present value of Project A is higher, making it a better choice. This simple logic underlines how crucial the time value of money concept is in financial strategy and evaluation. Application in financial decisions. The time value of money plays a critical role in financial decisions, especially in investment and financing. Investment decision, financing decision. Investment decisions involve, you see, evaluating whether the present value of expected cash inflows from a project exceed the initial investment cost. This requires discounting future cash flows to the present using the firm's cost of capital. Discounting, what do you mean by discounting? Suppose you take a check to the bank, you see, say 1 lakh rupees, you tell to the bank that I want to discount it, I want the money right now. So you see, bank will send this check in clearing. It will take 3-4 days. So bank will take from the customer 3-4 days interest, and bank will pay the money immediately to the customer, provided the conduct of the account of the customer is satisfactory. That is what is discounting. You see, what you can get, you see, today, if the net value NPV is positive, the investment is considered viable. For instance, if a project costing 1 lakh is expected to generate future cash flows that are worth rupees 92,000 in present value terms, it should be rejected as the return is insufficient to cover the cost of the, you see, investment. Financing decision in financing, TVM is applied to evaluate the cost of raising capital through methods such as issuing debentures or taking loans. When a company raises funds today, it commits to future cash outflows in the form of interest and repayment. These outflows must be discounted to the present to assess whether the financing cost is justified. The analysis helps in deciding whether to issue new debt and at what, you see, terms and conditions. So we have studied in unit 2, you see, time value of money. Now, what do you mean by time value of money? Time value of money is a cornerstone of financial management. It reflects the principle that money available now is worth more than the same amount in the future due to its potential earning capacity. The concept is applied in all major financial decisions such as, you see, investment evaluation, project selection, financing alternatives, and retirement planning. You see, it helps in comparing cash flows, you see, occurring at different times by converting them into present or future values. Mastering time value of money enables, you see, more accurate and informed decision making, thereby enhancing financial efficiency and profitability. So what we have studied in this, you see, unit 2, time value of money. The time value of money is a cornerstone of financial management. It reflects the principle that money available now is worth more than the same amount in future due to its, you see, potential earning capacity. The concept is applied in all major financial decisions such as investment evaluation, project selection, financing alternatives, and retirement planning. It helps in, you see, comparing cash flows occurring at different times by converting them into present or future values. Mastering time value of money enables more accurate and informed decision making, thereby enhancing, you see, financial efficiency and profitability. So we have studied in this particular unit, you see, simple interest formula, compound interest formula, simple interest, how we calculate, principal multiplied by rate into time divided by 100. Say for example, 1 lakh rupees, 10% rate is 10% per annum, and for 3 years we want to find out. What we will do, 1 lakh multiplied by 10 multiplied by 3 divided by, you see, 100. So we will get 30,000. So the interest will be 30,000, you see, for 3 years. Same amount, 1 lakh, if we invest for, you see, 3 years, and we have to find the compound interest. We have to do compounding, yearly compounding. So what we'll do, first we'll find out the interest of on 10,000 rupees at 10% for 1 year. So 10,000, 1 lakh multiplied by, you see, 10%, 1 lakh multiplied by 10 by 100 into 1, that is equal to 10,000. We get, you see, 10,000 interest for 1 year. Second year, our principal will become 1 lakh 10,000 rupees. You see, because this 10,000 interest we have earned will be added in the principal. So we will be finding out interest on 1 lakh 10,000 rupees for 1 year. So 1,10,000 rupees for 1 year, that will be, you see that interest will be 1,10,000 multiplied by 10 by 100 multiplied by 1. So that will be 11,000 rupees. Now for the third year, what we will do? We will add in, you see, principal 1 lakh, you see, rate of interest of the first year and second year. And then we will find out the, you see, interest for the third year. So 1 lakh plus 10,000, that is 1,10,000 plus 11,000, that is 1,21,000. Now on 1,21,000, we'll find out the interest at the rate of 10%, 1,21,000 multiplied by 10 into 1. This rate of interest is 12,100. So we saw the rate of interest for first year is 10,000, for second year is, you see, 11,000, and for third year is 12,100. If we add all these, so these interests will be more than 30,000, because the we have found out, you see, compound rate of interest. If we find simple rate of interest, it was 30,000. For compound rate of interest, it was 10,000 plus 11,000, that is 21,000 plus 12,100. So it will be 33,100. So if we do compounding, so we are getting better, you see, interest. So we are closing our session. Thank you very much.